that, all I did was to hit equal, click on this guy right here, times, open parenthesis, 1 plus the growth rate cell of 20%, so you close parenthesis. Now then, in carrying out this forecasting exercise, there are three items that would be dealt with on the income statement. They are beginning with sales, and then operating costs, which in this forecasting model called percent of sales, it's going to also go up at the same rate as sales, which is also 20%. So when I stayed there, I hit equal, clicked on this, multiplied by open parenthesis 1 plus the same rate of 20%. So that's the second item that will need to be adjusted. And the third and final item that will need to be adjusted would be addition to retained earnings. And that's going to be based on the dividend payout ratio. Here, dividends, as you can see here, is based on the rate of 45%. So all I did there was to hit equal, and then I clicked on the dividend payout ratio of 45% multiplied by net income. All right, and then the difference there, we don't really need the decimals. The difference that you see here is simply the difference between net income and dividends. So that's our addition to retained earnings. So these are really the three items that will need to be adjusted on the income statement. Again, sales, operating costs, and retained earnings. Everything else follows in the fashion of a pro forma income statement. Now, unless you have any kind of additional information concerning, for example, interest expenses, this is basically the model that should be followed. And then proceeding to the balance sheet, again, there's going to be three items that will need to be adjusted based on the percent of sales method. They are, number one, all current assets. So current assets would also increase spontaneously with sales. As you can see here, I raised each of these current asset items based on the same sales growth rates in this example of 20%. Now let's kind of leave fixed assets alone for now. The second set of items that'll have to change are the current liabilities, but only these two items here, accounts payable and accruals, because these are non-investor supplied sources of capital and they tend to change spontaneously with sales. And so in this model, we also have to bump them up, as you can see up here, at the same rate as sales. Now again, accruals and payables are the only two current liability items that would be allowed to change spontaneously with sales. The third and final item that will need to be modified would be retained earnings, because here we're going to have to, if I hit delete there, we're going to have to, in addition to the current balance of 15,470, add, if I scroll up here a little bit, add this new addition to retained earnings. So as the annotation here tells you that the old balance of 15,470 plus addition to retained earnings. That's it really. Now, many a time, you're not going to have to do anything with fixed assets in cases where the firm is currently utilizing them at less than full capacity. And so you'll simply have to come here, hit equal, and then reference this number right there. But in this example, if I may undo it, we are told that the firm is operating at full capacity and that fixed assets therefore would have to grow, in this case at the rate of 7.5%. So based on this specific information, we increase our fixed assets accordingly. Now we're done. So we add up our assets to find 47,036. We add up our liabilities and equity to find 46,282. And as you can see, our use of funds, our total projected assets, exceeds our source of funds, 46,282, by 754.3. This difference is called the additional funds needed. It is the amount by which assets, which our use of funds, exceeds our projected liabilities plus equity. So now the question is, what are we going to do? This company would need $754.3. These may be millions going forward. So this case says for us to raise any additional funds in the form of short-term debt, and of course it's going to cost us 12% in interest. So now we're going to begin the financing feedback. In the first pass, again, everything repeats except right here. The total interest charges that will occur as a result of financing this AFN that you see here would be equal to the current interest payment of 510 plus the interest charges associated with the new AFN. So sitting down here, if I hit delete, I hit equal, I reference the current interest charges, and to that I will add open parenthesis the interest rate here of 12% multiplied, if I may go down here again, multiplied by the new additional borrowing, the AFN. Alright, close parenthesis and hit enter. Alright, and that's it right here. That's how I got that 6010. Now, because the outflow of funds has increased, that's going to cause our revised net income to drop. And therefore, as you can see here, our retained earnings will automatically adjust. So now, we go down here in the balance sheet section under the first pass. And under the first pass, again, nothing changes right here in the assets section. In the liability section though, as you can see under short-term debt, this amount would be equal to the current short-term debt amount plus the AFN, the additional funds which would have to be borrowed, remember, in the form of short-term debt. So it's the old balance plus the AFN. But also because, scroll up just a tad bit, because our retained earnings adjusted, that means down here, if I hit delete, the revised retained earnings balance would be equal to the original balance of 15,470, not this amount right here, because this no longer holds, plus the revised addition to retained earnings. That's it. So when we do that, we have to recalculate our AFN. Again, it's going to be total assets minus total liabilities plus equity, and we still find that we have a gap of 29.87. So this gap would again have to be borrowed additionally at the rate of 12%. So now we have to embark on this iterative process until the gap turns to 0. So that means in this second pass right here, total interest payments would be equal to this adjusted balance right here plus 12% of this 29.87. So if I click on this cell right here, you will see, looking up here, that that's precisely what I did. If I hit F2, you will notice it's the blue cell E21, which is this, plus the interest rate of 12% multiplied by cell E51. The purple cell, if I go down here, is this amount right here, the new AFN that was determined in the first pass. Alright, so again, that's going to adjust our retained earnings. And so then, if we come down here, the total short-term debt balance would have to be adjusted to be equal to, I hit a delete, this running balance there plus this, sorry about that, alright, will be equal to this running balance here plus this new additional AFN. And then of course our retained earnings would again have to be adjusted, because again it's going to be equal to the original balance of 15,470. It's not going to be this, and it's not going to be this, because things have changed, right? Plus this revised amount right there. So that's how we got that. And so when again we calculate the difference between total assets and total liabilities plus equity, we find this skeletal difference right there, which we're a little bit of overachievers today, so we're going to have to fix that up. So up here again, our total interest charges will go up some. It's going to be equal to this amount plus 12% of that this new addition to retained earning, this new AFN right here, additional AFN I should say. So with that, retained earnings changes in this third pass, and then coming down here again, short-term debt will increase further by 1.18, and of course addition to retained earnings will be adjusted. It's going to be equal to this 15,470 plus 2770.6 to give us this. So now when you look at the difference between this total assets and this now revised total liabilities plus equity, it's virtually zero. And if you really want to do something unnecessary, you can do a final the fourth pass, and at that point it will be clean zero. But by this third pass you should be okay based on the data used in this analysis. So with all